I wanted to put together some content for us today about the art of the exit. And I think that this will be really valuable, the art of the exit. And after we go through this, then I want to take a look at this piece of content here. So it's the art of the exit and two, biases, two cognitive biases, the disposition effect and regret aversion. So I think these two pieces of content together should be really valuable for us. Let's go ahead and start things off with advanced trade management, the art of the exit.
All right, let's get right into it. We're going to talk about something that honestly is the biggest difference between amateur and professional traders. And it's not what you think. It's not about how they get into a trade, it's about how they get out. So let me just ask you this. What if the one thing you've been taught to do to be safe, to protect your capital, is actually the very thing that's quietly killing your account's potential? We're about to challenge a piece of conventional wisdom that might just change the way you look at your trades forever. Most traders, we obsess over the entry. We spend hours, weeks, maybe even years looking for that perfect, magical entry signal. But here's the hard truth from institutional data. The real money, the real edge, isn't made at the entry. It's made or lost in how you manage the trade after you've clicked the buy or sell button.
So you guys, the entry, that's the easy part. It's so easy to follow markets tick for tick and find that level where you want to enter a trade. But after you enter the trade, managing this thing, managing your brain and managing the trade, to exit properly, that is not easy, man. So this is going to talk about managing your risk in our terms. So removing that US dollar figure from the position and instead thinking about risk units. I think that's going to be really valuable to reframe the way we think about this.
And that management all comes down to this one core conflict that every single one of us faces. It's this constant psychological tug of war, right? You've got the fear of a winning trade turning into a loser whispering in one ear, and the dream of catching that massive account-changing trend in the other. How you navigate that battle, well, that defines your entire trading career. So let's talk about the most common way traders try to solve this conflict. It's a little move that feels incredibly smart, totally safe, and really professional. As we're about to see, it's often a well-disguised trap.
So the reason why this is a trap is because of basic arithmetic. If you bring your stop down to break even and then allow your profits to evaporate as the trade moves against you and you get stopped out for a break even, well, then you're not letting your winners run at all. And so you'll see the formula here in a second.
And this quote just says it all. Moving your stop loss to your entry point, it feels amazing, doesn't it? That sigh of relief when you've created a risk-free trade. It's a huge psychological win. But what feels good for our emotions can be an absolute disaster for our account's math in the long run.
Right.
Let's break down exactly why. Okay, this looks complicated, but it's actually super simple. This is the engine of your profitability. It's called the expectancy equation. And all that really says is that your long-term profit is determined by your win rate times your average win minus your loss rate times your average loss. That's it. This one little formula governs everything. And here's where it all connects. Every single time you move your stop to break even and then get nicked out by just the normal random noise of the market, what have you done? You've just replaced a potentially huge win with a zero. You are systematically attacking and shrinking the most important part of that equation, your average win size. You make it mathematically almost impossible for your winners to pay for your losers.
So that is exactly what I did over the weekend. I moved my stop, I trailed my stop down to a level where I locked in a profit. But the mistake that I made was I locked in a profit that was 90% smaller than what I should have been able to close the position for. Big mistake. And this is how we can fix it.
And this chart just lays it out perfectly. The break-even stop's primary goal, psychological comfort. It's there to make you feel better. A technical stop, one that actually adapts to the market's behavior, has a very different goal, profit maximization. One serves your emotions, the other serves your account balance. You've got to decide which one you're trading for. Okay, so if the break-even stop is a flawed strategy, what's the alternative? What do the pros do? How do we defend our profits without strangling them in the crib?